Hi, everyone. Mike White here. Welcome to this week's vlog post. It's amazing to see how the bond market is really trying to recover, is really trying to improve itself. In fact, both the 10-year Treasury and the 5.5%, 30-year MBS have improved to the point where they've broken their 200-day moving averages. And it looks like they really want to improve further. It's really important that you take note of this because you're not going to hear a lot of this out in the general marketplace when it comes to people's numbers and reflection of how the housing markets are doing or how interest rates are doing or people's appetite to buy houses. It's really important that you know where to look for this information and have this information available to you, even if it's just for background information for yourself. But the market's really trying to push its way, at least price-wise, the bond market going higher and rate-wise, rates going lower. And we can see, the writing on the wall. It takes a lot for the markets to break through something as tough as a 200-day moving average. And the reality of it is we can see that these things want to come together. And when we compare that, it's been just over a year since the Fed started raising interest rates, and those impacts are starting to show up. And we're going to get really important news both today and tomorrow in the job market. The unemployment numbers come out today, Thursday morning, and the March jobs report is going to come out Friday morning. And that data, it really might help us see that the job market is slowing, the economy is slowing, inflation is going lower. And if we look at just the ADP report from the other day, it really had some substantial information in there about how what sectors are driving unemployment. Those numbers were not what everybody had thought they were going to be. They missed estimates of jobs created. And again, it's only ADP, and the Fed doesn't really pay attention to the ADP numbers, but there tends to be a correlation between what ADP sees in real data versus what the household survey and the government picks up on. But the bond market really has a place to improve, and you have to know that, but you have to be prepared in case something wonky happens, which can entirely happen. Now, I don't think what's going to happen today or tomorrow are going to create a massive move, or a massive improvement. It's going to sustain this rally, or at least I believe, if the numbers show unemployment growing and the job market getting weaker, you'll see that it will help the markets as far as the bond market goes, improve for us all. And it may, not necessarily, because there's no saying what this Fed will do. To be quite honest with you, between the Federal Reserve and the Treasury Department, you probably can't find a group of people who have their fingers on the pulse less than those group of people about what's really happening in the economy. But that said, it'll be really hard to ignore fundamentals, which is it takes about a year for rate increases to hit the market. They only started last March. We're just starting to see the beginning of the pressure put on the markets because of higher short-term rates. And inflation is starting to come down. The economy is starting to slow. And again, all I can do is look at this and say, if you're paying attention to it, maybe we don't get further Fed hikes at this particular point in time. Maybe we get a pause for a little while so the Fed can see the results of month after month of continued rate hikes starting to slow things down. Now, not saying it's going to happen, but I'm saying it could or should happen. And what's going to come across the markets this morning and tomorrow morning are going to play a big role in that. The other piece is, activity levels. We're seeing housing numbers, we're seeing national data. And while the first half of this blog was around interest rates, which are a nationally controlled situation, activity levels are local. It's hyper local. It can come down to specific areas in your particular market. Averages across the country when it comes to household units and sales prices and days on market and inventory, those averages in a market like this one are not very helpful, because what happens in LA or San Francisco is not what we're seeing in San Antonio or Austin or Miami or, Atlanta or Alabama, whatever it is, Birmingham. It's got to look at the local market and see what's happening in your local market, because the raw data shares with us that all these wild predictions about how much housing was going to fall and the metrics that they're using, if you get it down to the smaller markets like I do every day with my clients, the pricing in the marketplace and what's going on when they look at their numbers is no indication of what we're really seeing. And what we're really seeing is a huge build in buyers coming to the market to get pre-approved. Now, the industry measures new loan applications. Unfortunately, they don't measure credit pulls and pre-approvals, because had anybody measured credit pulls and pre-approvals in their markets like my people do, they'd realize we're having a huge pre-approval build in our buyer inventory, and that we're seeing in a lot of markets multiple offer situations and houses going very quickly. We're hearing people complain about inventory, and it's not like they haven't been complaining about inventories forever, but this time of year we usually see a significant build in inventories as people prepare for the spring buying season to move their kids from school. That stuff, it starts to happen, and it really hasn't yet this year, which puts further pressure on what's going on. So you need to pay attention, to the bond market and how it reacts to the unemployment numbers today, the jobs report tomorrow. But furthermore, you've got to dig down into your own markets. You've got to get your own local data. You got to talk to the people on the streets that are working, not what they think about what's happening, but what they're really seeing. How many houses are in the market? What is your local inventory? How many offers are they getting? How close to the price point of sale is this? What are the people? Because national numbers are not indicative of local markets. Never have been, never will be. So pay attention to what's going on here. The news today, tomorrow could be significant. It could help further the improvement in mortgage rates. I do see rates improving through late spring and into the summer. Exactly when and how far we go is yet to be determined. But the movement has already started. And you just have to look at the 10-year Treasury and you have to look at the 30-year mortgage-backed securities, and you can see that there has been some really good activity going on there, and there has been some price improvement. And with a little bit of help today and tomorrow, we may see a continuation of that. As always, if you have questions or comments, it's Mike at imtcoaching.com. We'll talk to you again real soon. Take care.